U.S. natural gas futures ended the week in positive territory, though the advance was largely technical in nature, underpinned by short covering and end-of-month positioning rather than fresh fundamental drivers. While the rebound signaled a potential shift in momentum, the broader market backdrop remains challenged by persistent oversupply, muted demand, and a lack of meaningful weather-related support. Without a clear catalyst to alter the supply-demand balance, traders remain cautious about the durability of any upside move. Meanwhile, natural gas prices struggled to push higher even as total U.S. consumption increased by 1.7 billion cubic feet per day from the previous report week, with gains concentrated in power sector demand and exports to Mexico. On the supply side, average U.S. production showed little sign of easing, slipping by only 0.1 billion cubic feet per day, a marginal decline that underscores the resilience of output at current levels. The limited supply pullback, when set against only modest demand growth, highlights the ongoing imbalance that continues to cap upward price momentum. Comparing the current EIA forecast with last year reveals notable similarities, particularly in storage levels and the pace of LNG export growth. Looking back at last year's price dynamics, the market began to climb once new LNG facilities came online in December, with gains further supported by colder than normal weather in January and February. This year, another wave of LNG capacity is slated to come online between October and November, which could provide a similar bullish catalyst. However, the outlook for winter weather remains highly uncertain. Historically, colder winters are often followed by milder ones, making temperature patterns the key variable likely to shape price direction in the coming season. Moreover, the current spell of warmth could extend into early winter, potentially dampening bullish expectations for LNG-driven demand. The market continues to defend key weekly support at $3, but without a decisive move above $3.40, the established weekly swing top, the broader trend remains bearish. A breakout above $3.40 could generate sufficient momentum to challenge the next resistance level near $3.80, though conviction remains limited. From a fundamental perspective, oversupply, soft demand, and lackluster weather-driven consumption provide little justification for sustained upside. As a result, any rallies are likely to attract renewed selling pressure, with the latest rebound best interpreted as a technical correction rather than the start of a broader bullish trend, unless stronger demand signals or supply disruptions emerge. Yet the weight of strong storage levels, record-setting production, and limited heating demand keeps downside risks firmly in play. Without a convincing push-through resistance, the bias tilts bearish, with traders setting their sights on the $3 support zone as the next potential target. Don't forget to drop a comment, check out the last video and support the channel. Catch you in the next one.